Wait, we are now here. Okay, class number 5, 24th of August 2024, which is today lah. So we are still on online class. And then 31st of August is a public holiday. So I don't think you want to come back on a public holiday, right? I don't know yet. So this is a question mark. Likely is that we will not have a class on a public holiday. But according to the schedule, 7th you have class, 14 you have class. Sorry, 14 is a break because I think Miss Lim and myself, we are not available for that weekend. And then subsequently all the way until class number 11. But on the 26th of October, suppose it is your break. But most likely, this particular Saturday, there will be a class. Okay, there will be a class on the 26th of October. Okay, then there will be some adjustments thereafter lah. That means from the 26th to the end. Okay, so this one, I need to go and discuss with Miss Lim, who is going to take over from class number 6 first to see what her schedules are like before we can just confirm to you lah. But likely is that on the 26th, you will have a class. Is there any issues with that or not? Any issues with having the class on the 26th of October? It is a Saturday, all right? But according to the original schedule, this is supposed to be a off week. That means you don't have classes. But we need to do some timetable adjustments because of some, how do we say, some plans by the management. Okay, so later, I think CEE, once they confirm with us, CEE will get back to you on the schedule and what is the plan by the management. Okay, but may I know whether 26th of October, anyone has any issues or not if we were to have the class? If you have issues, can you just put it at the meeting chat? If no issues, you just put no, no, no. No issues. Can? Any issues with having class on the 26th? Can you hear me or not? Oh. Any issues with having classes on 26th of October? Oh, no issues, Okay. Okay. All right. So that will be good. Okay. So likely is that on the 26th of October, we will have class. But then there is still one more class that I need to discuss with Miss Lim first before checking with the students. Okay. All right. So that is good. So the thing here is that likely there will be some changes lah. So like I say, CEE will do the announcement. And then the other thing is that we will just take away the break lah. And then maybe your last class will be like 1 week after the scheduled date. Okay, so probably, a little bit 1 week longer than the original last date. Okay, so later CEE will make the necessary announcement, and then we will just adjust the class accordingly lah. Okay, no issues with that. Okay, thank you so much. So what I want to do today is to continue from what we have done in the last class. All right, so in the last class, we have actually looked at basic group, and some of the things that we have looked at are just to recall your memory, because later on, after today's class, then Miss Lim will take over and she will start on the complex console together with the group statements of cash flows, and then together with the Forex. So sometimes the questions are interlinked together, so it will be easier to discuss them together. Okay, so we have talked about consolidated financial statements. So this one we have already looked at it in the last class. So you must know the difference between exemptions and exclusions. And of course, you can also look at the your, what do you call that? Your cost book, with respect to why sometimes exclusion of a subsidiary from the consolidated financial statement may raise ethical issues. Okay, so these are just in case questions are being raised on the ethical concerns. Then we have looked at the acquisition method, how to calculate the goodwill, and the resultant accounting treatment if you have impairment of goodwill. Okay, so this one later, when we look at some of the illustrations, we will have this particular recall and how to capture them correctly in the financial statements. Okay, so investments in the subsidiaries, if they were to talk about the definition of control, usually you have to discuss Roman 1, Roman 2, Roman 3. Okay, these are what we call the knowledge or the principles. Then after you have listed down the knowledge or the principles, then you're supposed to apply it to the facts given in the case. We have also looked at investments in associates, right? And we look at this particular illustration on how not to double take the URP from the intra-group sales with the associates. Okay, so we have mentioned that, oh, this particular unrealized profit that we have computed, we have already taken partial elimination. So in other words, we are not supposed to, like, put them under the column of the associate. We shouldn't put it here. Okay, because if we were to put it here, then you will have double taken, because this particular figure has already taken the 30%. Because if you put it here, then the net here, we are going to take a 30% again. Okay, so that will be double taking it first time here, second time here. Okay, with respect to this URP with the associate. So that is why you have to change the positioning of this particular 60,000 and put it under the column of the parent, so that we do not double take the 30%. Okay, so this one we have already gone through. And then we have also looked into quite detail with respect to what constitute cost of investments in the acquisition. So it could also apply to the investments in the associates as well. So of course, we look at deferred consideration, where we need to take the present value. If we are looking at contingent consideration, we have to take the fair value of the contingent consideration at the date of acquisition. Okay, and of course, always remember that if you present value the deferred consideration, subsequently, as time passes by, you're supposed to do the unwinding of the interest. Okay, so this one we have already done. We have also looked at one example with respect to ABM mining on the joint operations. Okay, so this one, okay, no issues. And then thereafter, we have looked at the shark and minnow. All right, so that is where we stopped in the last class. So today we are going to just continue on because we want to look at this particular illustration called Otway. Okay, so of course, when you look at a business combination, you indirectly need to know IFRS 3. Okay, so this is with respect to, actually it's 13. This is with respect to fair values. Okay, so in other words, what's the definition of the fair value? So the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market, usually here we have the word participants, between market participants, okay, at the measurement date. Just give me a minute. market participant at the measurement date. Okay, so you can see that in accordance to the fair values under the IFRS 13, we are actually looking at the market. All right. Another one that we look at is VIU, value in use. Value in use, this is from the entity perspective. Okay, so later on, if you have the opportunity to look at some of the questions with respect to IFRS 13, you will realize that you need to actually be able to distinguish between the market participants, the market's performance as well as the entity's performance. Okay, so in line with IFRS 13, you will be looking from the market perspective. If you calculate VIU, VIU is actually looking from the entity's perspective. Okay, so later on, you will look more in detail on IFRS 13. And then, of course, goodwill are arising on the acquisition. So this one we already know, because when you want to compute the goodwill, usually you estimate the fair value first. Fair value of your building, of your machinery, whatsoever. All right. So usually when you calculate the goodwill, they are measured provisionally. So which means that agak-agak figure. So you will wait until the valuers come back with the confirmed figure. And should there be any adjustments to be made to the provisional figures, you are going to take them into account only if those provisional figures were obtained within 12 months from the date of acquisition. All right, so you are going to make adjustments to the provisional figures that you have computed earlier. But let's say the valuers only came back to you with the let's say correct or accurate fair value only after more than 12 months. So in other words, you don't have to make any adjustments. So any adjustments thereafter should be treated as a post-acquisition adjustment. Okay, because when we calculate the goodwill on acquisition, these are always at the date of acquisition. Okay, so if you get the actual figures within 12 months, then you adjust retrospectively. If you get it after more than 12 months, there is no necessity for you to make the adjustment, because any adjustments thereof will be captured when you do the post-acquisition adjustments. All right. So consolidated profit or loss and OCI as well as console SOFP. Later, we will look at this Bailey group. So Bailey group is also found in your PPT slides that I've given to you earlier, as well as in your course book. Okay, so this one is a comprehensive one whereby they ask you to prepare everything. Console SOPL and OCI as well as the console SOFP. So this one, we will look at it later. Then, of course, we already know how to treat upstream, downstream kind of transaction and associates losses. Investor should report its investment in associate at nil, zero. Okay, because remember in the last class, we could have investment in associate. Okay, so if you have investment in associate T account, what will be the first figure over here? You will have the cost of investment originally paid to acquire the investment in the associate. And of course, if the associates is making profits, then the group, the holding will have a share of the profits post-acquisition. Your share lah, let's say if 30%, then it will come under the debit side to increase the value of the investment in the associate. Okay, but let's say the investment or this particular associate is not making profits. So which means if it's making losses, you also have to put a share of the losses. So share of the losses will go to the credit side of the T account. Okay, and if this particular share of losses is greater than of the cost of investment, then what happens? You will have a balance. Usually we balance off the investment in the associate. The balancing figure will be on the credit side. Correct or not? So mathematically you will find that at the end of the day, when you want to carry the figure to the console SOFP, you will find that now the figure appears on the credit side. So you cannot show it like this. If you have a console SOFP, okay, you are not allowed to show investment in associate at a bracketed, let's say bracketed 10, cannot. Okay, so let's say this figure is 10. Okay, so which means that you carry to the next period on the credit side the 10, but you cannot put it in the console SOFP a negative figure. So at most, what you can do is just put nil. Okay, understand what I mean now? So this is the presentation in the financial statements. So NCI must be shown separately, and NCI usually we put it as part of the shareholders' equity. So which means ordinary share cap, all your reserves. After you finish all the reserves already, then you will have the NCI, and NCI is shown separately in the financial statements. Okay, so you have this. So now we can go to the comprehensive question, Otway. So Otway is here. So you see the tabulation as given by the question. So you will see that there are many columns. Okay, and over here, because this question is quite an old question, they still have the element of share premium. So when you see share premium, you just change it to OCE, other other components of equity. Okay, and over here we shouldn't have any more par value, but we just imagine that numbers of shares is the same as the ordinary share cap value. So like in this case, 400 million is the dollar value, but we will know that 400 million is the numbers of shares. Okay, because later we need to use the numbers of shares to calculate what's the percentage of acquisition. All right, so you have this particular question. So share premium, you just change it to OCE, other components of equity. Okay. So when you look at this particular question, of course, the first thing that you need to do is what? Look at what is the requirement of the question. So this is to prepare the statement of profit or loss and OCI for the year for Otway Group. So which means this should be a consolidated SOPL, OCI, and the consolidated SOFP as at 30th June 20x6. So which means this is the date of the consolidation. All right. So what you need to do is at the initial instance, usually you will have to put what is the date of acquisition. And then you can see from here, you have two companies. One is called Hogarth. Okay, so you split. Then another one, what is the date of acquisition in letter B? Okay, then we already know what is the date of consolidation. Okay, date of console, 30th, date of console, 30th June 20x6. Okay, so you have all these already. So 30th June 20x6, you can either get it from the question or you can get it from the SOFP, SOPL given to you. Okay, so can we find what is the date of acquisition in Hogarth? So over here, the first thing that they tell you, Oatway, a public limited company, acquired a subsidiary called Hogarth on the first day of July 20x2. So this will be first day of July 20x2. So which means from this date to the date of consolidation, how many years has passed by? So x2 first day of July. So it will be 30th June, x3, x3, x4, x5, x6. So that means 4 years has passed by. Okay. Then we have the next one. The next one being what? An associate called Better B on the first day of July 20x5. So x5, x6. So this one to here, this is only 1 year. Okay. So, and then they already tell you in terms of the Hogarth, it is a subsidiary. In terms of Better B, it is an associate. So how many percent did we acquire? You have to look at the details given to you here. All right. So like I mentioned, ordinary share cap value, we just treat it as the same as the numbers of shares in Hogarth. So all in all, Hogarth will have 400 million numbers of ordinary shares. Out of these 400 million numbers of ordinary shares, 320 million is acquired by the holdings. So 320 divided by 400, you will have a 80%. So this is 80% acquisition. So of course, this confirms that Hogarth is actually the subsidiary. And then with respect to Better B, it is 55 over 220. So you get a 25% acquisition. So 25% satisfies the definition to state that Better B is the associate of Oatway. Okay. And then every time you see this particular figure given to you, fair value of the net assets at the date of acquisition. Usually when this figure is given to you, you have to reconcile because when you want to calculate goodwill, you always have to compare the cost of investment plus with the NCI, compare with the fair value of the net asset to calculate how much is the goodwill. Okay, so over here, if the fair value of the net asset at the date of acquisition is given to you, so suppose that you just use the figure to calculate goodwill, right now. But if this figure is given to you, usually you have to do a reconciliation. What makes up this particular figure? So usually ordinary share cap, OCE at the date of acquisition, retained earnings at the date of acquisition, revaluation surplus at the date of acquisition. So when you sum up all these, 400 plus 140 plus 120 plus 40, you only got 700. But over here, they tell you the value should be 800. So which means this tells you that you have a fair value adjustment. Okay, so in this case, fair value adjustment upwards of 100 million. Okay, so do the same for Better B. So for Better B, 220, 83, 195, 54. So you have 552. But over here, the net worth they tell you is 652. So again, you have some fair value adjustment at the date of acquisition. So it will be good when you want to calculate goodwill, give a breakdown of all these figures so that it shows that, yeah, I'm aware that there are some fair value adjustments. Okay, and this one is the cost of investment. So for the cost of investment, you have to just make sure that it has been captured correctly in the books of the holdings. So how much is the cost of investment in Hogarth? 765. So this one will appear in the books of the holdings 765. For Better B, 203. So 203. And then remember, the investments in Hogarth will never go to the console. Okay, but for investment in Better B, since this is an associate, then later on you have to prepare the T account for the investment in the associate, carry it to the console SOFP. Okay, got that, huh? So this is some of the reconciliation that we can do. So PPE, no issues, intangible, no issues, all this, no issues. Revaluation surplus, no issues. Okay, then the rest, no issues. Then over here, this is the SOPL for the respective companies. So you have Oatway, Hogarth, Better Be. All right. And since you are looking at this, you have to be a little bit concerned or careful with respect to dividend income. But over here, they already tell you that this particular dividend income are from members of the family. So the thing that you need to do is to reconcile to make sure that 260 is the correct figure. All right. Otherwise, let's say if you have no time to do reconciliation, when you prepare the console SOPL, you must never carry this particular dividend income to the console SOPL. The reason is because the whole lot of this 260, the question tells you they are from Hogarth and Better B. So since we are looking at this, it will be good for us to reconcile to make sure that this 260 is really will be eliminated at the console. So how do we check? So after this, which means that we have to look at what? Hogarth, Better Be. So this is the holding company. This is Hogarth. And then this is Better Be. Okay, so we have to see whether did they pay any dividends or not. So over here, we can see that Hogarth in the year, they paid some dividends of 300 million. In Better Be, they also paid some dividends of 80 million. So remember, what was the percentage of acquisition in Hogarth? 80%, 25%. So which means we double check. Of this, 80% will go to Oatway. Oatway. So this one is Oatway, huh? Let me just put this. This is Oatway. Oatway is the holding, huh? So 80%. So 80% times with 300, we have 240 going to Oatway. 240. Then remember in Better B, the holding has 25% share. So 80 times with 25, you have 20. So 240 from Hogarth, 20 from Oatway. From Better Be. So this one sums to 260. 260 will be eliminated at the console level. Understand? So this one, you just need to reconcile. But if you do not reconcile, just remember that since the question tells you that they are from members of the family, you must not carry them to the console SOPL. Okay, so this one, not much of an issue. Revenue, cost of sales, normal. Okay, so this one, not an issue. Then we look at the additional information. So they tell you, neither Hogarth nor Better Be had any reserves other than retained earnings and the OCE. Okay, other components of equity. So they tell you they didn't even issue any new shares since the acquisition. So nothing to do. So fair value difference on the subsidiary relates to PPE being depreciated through the cost of sales over a remaining useful life of 10 years from the date of acquisition. The fair value difference in the associate relates to a piece of land which has not been sold since acquisition. So this particular fair value difference that they are talking about basically is the 100 that we have actually gathered just now, this fair value adjustment. So they say with respect to Better B, it is on land. With respect to Hogarth, it is on some PPE. So if it is with respect to some PPE, then you will know that you have to provide some depreciation. Okay, so in other words, we will have what? For this item, additional depreciation due to fair value adjustment upwards. How much? 100, right? 100 million. And then they tell you they have a remaining useful life of 10 years. But then remember, how many years has passed by since the date of acquisition in Hogarth? So 4 years. So you need to times by 4. Okay, so this one will give you 40 million. You need to adjust this to increase the depreciation expense in the books of the Hogarth. But with respect to the Better B, they tell you that it is with respect to a piece of land. So, which means that no depreciation is required. All right. Then the next thing is that they talk about NCI. How is NCI being measured? At fair value. So remember, when NCI is measured at fair value, you are going to capture the full goodwill. Okay? And the question has given to you, how much is the value? So this is given. This is 1st July 20x2. So 1st July 20x2 is actually the date of acquisition in Hogarth. So they didn't give you the share price, but they gave you how much is the fair value of the NCI at the date of acquisition. So you just need to use this when you calculate the goodwill. Then what else they have? Item D. Hogarth intangible assets includes 87 million of training and marketing expenditure incurred during the year ended 30th June 20x6. That means in the current year, they incurred 87 million with respect to training and marketing expenditure. And what they have done is they have included it as part of the intangible asset in the books of Hogarth. So let us have a quick look. In the books of Hogarth, do we have any intangibles? We have intangibles. In the books of Hogarth, we have 350. So the question tells us that included in this 350 is some 87 million. And this 87 million is with respect to training and marketing expenditure. So remember, the last time when we looked at this, we say that what? Training, marketing expenditure, just like advertisement like that, they are not fulfilling the definition as an intangible asset. So which means that they should not have been capitalized, okay? Because they tell you, the directors of Hogarth believe that this should be capitalized as they relate to start-up period of a new business venture in Scotland and intend to amortize them over a 5 years period. Okay, but you see, who suggested this? The directors. So I mentioned quite a number of times, if the directors, if the question mentioned the director suggests this, director suggests that, 98% of the time you have to have a red flag already. So which means that, you have to ask yourself, really or not, what the director say is true or not? Because from your experience, 98% of the time, whatever they suggested, not correct one. So this is also one of the case. They say to capitalize, but you shouldn't have capitalized it. So which means there is an adjustment that you need to make. So if you cannot capitalize this training and marketing expenditure as an intangible asset, which means that you need to expense it off. And when you go and do the necessary adjustment, this particular figure here, you have to minus out the 87. Okay, because they should have been expensed off. So in other words, your double entry will be what? You debit the retained earnings of Hogarth and then you credit the intangible assets. Okay, and then this one, During the year ended 30th June 20X6, Hogarth sold goods to Otway. So which means that Otway is the holding, so we will draw it on top. Hogarth is the subsidiary, so we will put it at the bottom. And how to draw the direction of transfer? You look at who sold the goods to whom. Hogarth sold to Otway, so which means this is an upstream transaction. Intra-company sales and purchases will be 1,003. So this one later, we need to eliminate intra-co sales and purchases. Okay, so the company makes a profit of 30% on the selling price. So when they give you 30% on the selling price, this means they give you the information about margin, because margin is upon selling price. Okay, and 140 million of these goods were held by Otway on 30th June 20X6. So, which means what? You need to calculate the URP. Okay, first we calculate the URP at the closing. Why I say closing? Because over here they tell you on 30th June 20X6. So that one is the closing. 30th June 20X6. Because usually, I don't know whether you realize or not, but when you calculate the URP on the inventory, the situation given to you is always on year end. They will tell you at year end how much remains unsold. Correct or not? So calculation of URP in the closing URP that is attached to the closing inventory, we always have what? Value of inventory that remains unsold, which is 140 million. And then they tell you 30% on the selling price. So which means margin. So if margin is given, you just times by the margin. So 140 times by 0.3. So this will give you 42 million. Okay, value of the inventory that remains unsold. And then you see over here, they also gave you something else. What is the something else that they gave you? They say, there were also some 60 million of the intra-company goods that has not left the group boundary in your opening inventory. Why do I say in the opening inventory? Because remember, closing inventory of the last year, which is X5, will become the opening inventory in this financial year. Okay, so which means this particular opening inventories URP, we also need to calculate. So we will calculate URP on the opening inventory. So same way of calculating 60 million times by 30%. So you are going to get 60 times by 0.3, you're going to get 18 million. Okay, got that now. So this is on the opening inventory. This is on the closing. Okay, and how do you normally do the adjustments? Let's say you have the console SOPL. Okay, when you do the adjustment, you will have what? The revenue, okay, the cost of sales. Cost of sales, usually what you do, take the holding plus with the subsidiaries cost of sales. Same goes with the revenue, H plus S. Then what you're going to do? You're going to minus intra-company, intra-company sales. Over here, you minus intra-company purchases. Agree or not? Of course, the sales and the purchases will be the same figure lah, as in this case, 1.3 million, 1.3 billion. Then thereafter, you will get the figure to go to the console SOPL. But for the cost of sales, we still need to go and make adjustment for the closing inventories URP. So in this case, we need to plus back 42 because this is the closing inventories URP. Okay, and if the closing we plus, which means that the opening we must pass the opposite sign. So we minus the 18 million. Okay, understand? And in this case, because just now we have calculated the depreciation because of the fair value adjustment, and they tell you that this particular figure, you need to place it in the as part of the cost of sales. So we will have another 40. Okay, so you will get the figure to go to the console. Following so far? Okay, and when you prepare your console SOFP at the end of the year, so you will have your current asset, right? Under your current asset, you will have inventory. So the inventory here, you just take H plus with the assets inventories, then you need to minus what? This particular URP only, minus 42. You get some figure to go to the console SOFP. All right, why we take only the 42? Why is it that we do not need to make any further adjustments to the URP that is attached to the opening inventory? The reason is because this particular URP that is attached to the opening inventory would become realized already as time passes by. Why? Because let's imagine when you have the inventories for the year ending 30th June 20X6. So of course you have the opening inventory, which was the closing inventory from the last period. Then you have purchases batch number 1, purchases batch number 2, and so on. Let's say you have until purchases batch number 5. When you have this particular portion of the closing inventory, likely is that they come from the most recent batches, correct or not? So maybe let's say the whole batch of purchases number 5 were not sold. So this must be forming part of your closing inventory. Okay, so when you sell, of course, you are going to sell off your inventories that appears the oldest that you have purchased, correct or not? So when you sell, it will be what? First to come in, first to go out, all right? So when you sell, you're going to deliver the opening inventories values to the customer first. The next time you sell, not enough, you take from here, then deliver to the customer. Then you take from here, deliver to the customer. So if you have some sales, most likely is that the opening inventory would have been sold. So if you have sold it, which means that it has been change hand to the third party. So if you change hand to the third party already, then what? The profit becomes realized. So when the profit becomes realized, you don't have to do further adjustment. So it becomes okay already. Understand what I mean now? So of course, at the cost of sales, because you also have components of opening inventory, so you need to make adjustments here. Okay, but at the console SOFP, because this is always at year end. At year end, the unrealized profit that is attached to the opening inventory would have been sold to third party. So it becomes realized already. So it's okay already. There is no necessity for you to do any more adjustment at the inventory level. Okay, got that. So of course, the opening inventory scenario is quite rarely appearing lah. Okay, but should you have it appearing, then you must know what to do lor. Okay, then what is next? Annual impairment indicated that impairment loss of 100,000 relating to the recognized goodwill of Hogarth including 25 in the current year. So this means what? Of the impairment loss of 100 million, they tell you previously 75 million. This year, current year, 25. Current is 25. Why do we need to split? Because when we prepare the console SOPL, impairment loss, we only need to take the current year. Because when you prepare SOPL, it's always at console SOPL for the year. For the year. For the year actually translated will be what? For the year ending, whatever. For the 1 year. Okay? For the 1 year. So, which means that when you have total of the impairment loss to date of 100 million, you need to split. How much is it that is for the current year so that you can bring it to the console SOPL? But of course, the goodwill that will appear in the console SOFP, you have to minus the whole lot of impairment loss to date. Whatever is the goodwill before impairment, you have to minus the 100. Okay? Oatway Group recognizes impairment losses on goodwill in cost of sales. All right, this one is also an instruction of the question. Usually we do not put the impairment loss in the of the goodwill as part of the cost of sales. So which means later over here, you have to plus the impairment loss on goodwill. Okay, so of course this is a requirement of the question. Then they tell you no impairment loss is necessary for the investment in Better B. Okay, got that? So basically the adjustments are not difficult. So what you need to do is that whatever that has been given to you, got pre-post one, you are going to split. Pre-post, pre-post. Okay, let's say like for example, for the OCE, 140 in Hogarth. So OCE 140. Oh, they tell you these are all pre. Okay, let's say Better B, OCE 83. So these are all pre. So everything would have been eliminated. Nothing will go to the console. Okay, then retained earnings, you have to split. No? Retained earnings 120. So retained earnings, you split. Pre 120. So the balance must be post and so on. So you do the same for this one. Pre how much, post how much. Okay. Pre-post revaluation surplus also 40 pre-post. Pre-post. Okay. So we can quickly go and look at the solution. Of course, the console SOFP, later the figures one by one, they have the workings on. Okay, so the share premium, we change it to OCE. Okay. So you can see that quite a lot of the workings, they put W10, W whatever. Try not to put too much of those that you need to, can you imagine? The marker have to scroll up, scroll down, scroll up, scroll down. Because when they mark, they also mark on your soft copy. So it is like, there is a whole chunk of scripts down there. Whenever they finish marking, then another one will drop from the sky like that. And then they will catch it and then they will mark. After finish marking, they upload back. So usually they also are under time pressure to complete the marking. Of course, even though they are paid and they are paid very well for the examiners, for the markers of this professional examination. So but then they are also time pressured because Immediately after your exam, not too long after that, then you get your results already, ma. Before that, there are certain procedures. You get what I mean or not? Because the how do we say, the markers, you see, they will be something like this. Let's say the markers, they must maintain a certain consistency, ma. So the papers will drop, drop, drop. So let's say 1, 2, 3 are the actual scripts of the students, but there will be one somewhere in between, those scripts that are dropped, let's say drop from the whatever portal, to them. There will be some is what they call a control sheet. So that means they will have to mark the control sheet, and then the control sheet probably they would have already known. So let's say this script, most of the markers should get about 60. But if you mark and then you get 40, then that means you are not consistent already, ma. Then another bogus strip will drop from the portal. All right, so they will make sure that you mark until you become consistent already, then only the real one will drop again. You get what I mean? Now, that's the control that they have. But the marker would not know which is a genuine one, which is a control one. Okay, so there is some ways for them to check the consistency one, so you're not worried. But the thing here is that, you see, if you're going to put W10, then they have to go and scroll. Wow, where is W10? Oh, W10 is here. Okay, so this is just a fair value adjustment. So remember just now, our fair value adjustment is quite simple, Niran, right? Fair value adjustment. We only have what? Holding plus with the subsidiary. And then we have what? Fair value adjustment upwards with respect to the PPE. Then what else we have? Fair value adjustment with respect to the PPE and the corresponding depreciation expense. So you have to minus the additional depreciation due to the fair value adjustment. Okay, so just have a quick look at this, which means what? Fair value adjustment upwards, we already know the figure was 100 million. How much was the additional depreciation that we have computed? 40. So which means 100 minus 40, this is your 60. So these two figures combined together is this 60. So what you need to do is you just put 1012 plus 920. Then you put plus 100. And then fair value adjustment upwards with respect to PPE, you put a bracket. Then you minus the 40. 40, you're going to put the bracket. What is the description? 100, what is the description? That will be good enough. You understand what I mean now? Do not torture the examiner to go down to W10, whereby it's a simple one. Understand? So no need to do it like that. You do it like this, they'll be very happy. Oh, this one, then they give you the marks already. You get what I mean? Goodwill, you need to give the workings. Okay? Like in this case, if you have investment in associate, likely is that you need to have the workings. Then what else? Workings for the group retained earnings, you need. Other than that, if two figures, one H plus S, no need to show workings. Okay? NCI, usually you need. Okay? So let's say in general, if you do not have any investments in the associate, goodwill computation, GRE, NCI. Usually you need. These are the minimum. The rest of it, you see whether they are required or not. You see, like over here, when you do the inventories elimination of the URP, so you only have H plus S minus the 42. You can bracket after 42, bracket URP. Okay, then it is understood. So that means just in case some of the figures are the same figures. Okay, so you just tell them, I know this 42 is with respect to the URP. And then remember just now, here we also have this 100 fair value adjustment upwards for beta B, and this is with respect to what? A piece of land. Okay, so this fair value adjustment upwards with respect to the piece of land, why is it that we do not make any adjustments when we compute the PPE figure? Why no need? Why is it that we don't plus fair value adjustment upwards with respect to the land? Why no need? Anyone? Why there is no necessity to add the fair value adjustment upwards with respect to land at the console SOFP? Why? Anyone? This is just testing you on the basics, okay? So remember, this particular fair value adjustment upwards for the land appears in which book? Okay, where's this thing? Appears in which book? Fair value adjustment upwards with respect to the land. Land. This is appearing in the books of Beta B. And how many percent did the holding own in Beta B? 25%. And 25% gives you a status as an associate. If you are an associate, do you consolidate? No, but you just equity account. Okay, so if you equity account, which means that you don't add across. Okay, so you only add H plus S. So any adjustments with respect to the subsidiary, you are going to make the adjustment in the books. For Beta B, you are not going to take the figures over here to the console. So therefore, even though you have made some adjustments over here, you do not, I repeat, you do not add across. Understand? Hmm? Okay, not? Yeah. All right. Because the other day someone was saying, when we attended some of the those webinars and so on, they say when you do a online class, please do not talk and talk and talk and don't pause. Okay, I think I have a tendency to just continue talking. Okay, so I usually don't pause that long for the student to respond. Okay, so they say that no, you must pause long enough for the student to respond. So I will pause today. Hopefully that you have time, because they say that if you continue talking and talking and talking and you didn't pause, which means that what? You didn't give the opportunity for the student to digest. Before they digested, then you go on to the next thing already. Okay, but like I say, some of these things are easy ones, so I think no need to pause that long lah. Okay, all right. So this one, remember, it is equity accounted, so therefore you don't have to add. Okay, because I would find that sometimes when you do your console adjustments, you just do it mechanically because usually for the undergraduate studies, the format, the adjustments are more or less the same one. But it's just that when you have the peculiar adjustment, you suddenly forget, how to make the adjustment for this item. All right, or suddenly, why I never add, then you also don't quite understand why. Okay, so that's the reason why the ACCA have changed the style of answering or for setting their papers into the SBR, because they say, I don't want the students to be mechanically just know how to plus minus, then they must explain why. So that is why right now a lot of the question work is explain. Okay, so let's say if the question tells you, why is it that the fair value adjustment upwards for the land is not included in the console SOFP? Then you must explain, no? You get what I mean, no? But if the question didn't ask for explain, just ask for prepare or compute, then you also don't know why, but you know how to do. You get what I mean, no? So that is why they changed the format so that the graduates are the ones who can explain why the transaction is like this or why you should do it like that. Okay, so you can see if there are two figures, which means that only H plus S. And always remember, unless there were some shares that were issued as part of the purchase consideration, the share cap here will not change. Okay, and you do not add with the subs figures. Okay, because the subs OSC would have already been eliminated when you computed the goodwill. Okay, so let us have a quick look. And over here, this one is already something that we know already. 4 years, 1 year, 80% subsidiary, 25% associate. All right. So this is for the computation of the goodwill. This particular 188 is given to you. Given to you. This is the computation in the books of the subsidiary, investment in the subsidiary. 765, you extract from the question. So then these are the ones that is already given in the question. And this was the balancing figure, which is the fair value adjustment upwards with respect to the PPE. So you compute, you will get this particular goodwill before impairment. All right, before impairment. Then this 100 is also given to you, 75% with respect to the impairment loss previously, 25, and not 25%, 25, 75. So 75 is previous periods, 25 current. So this 25 will appear in the console SOPL. Okay, then your investment in associates, this one you should know lah. So in other words, you just take your share of the post-acquisition retained reserves. Okay, 263 plus with 62, 263 plus with 62. So which means they are these two figures, this and this. Okay, because for the OCE, they tell you everything is pre, this one got pre, got post. This is the total. So total, you have to remove for the better be reserves that are pre, revaluation reserves that are pre. Okay, so you minus 195 minus 54. So where is it? Minus 195 minus 154. Then you take a 20% there off. This will be your share of the post-acquisition retained earnings plus with the share of the post-acquisition ARR. No impairment loss, so you're going to get 222. Of course, this particular 222, you're going to take it, this 222, you take it and then put inside your console SOPL, SOFP 222. Okay, investment in the associate. Then your console RE, this is something that usually you have to do. Okay, so usually what we do is we extract the first line as per question. So this is the first line. Second one, usually we will minus the pre. And then all these are the adjustments that will make an impact on the subsidiaries RE. Then only we will put here. Okay. URP, this is because it is upstream. The intangible assets that was wrongly capitalized, I mean the expenses that was wrongly capitalized as an intangible. And then this is the depreciation additional because of the fair value adjustment upwards. So you campur tolak, you're going to get 520. Okay, suppose you can have a shortcut to put the impairment loss to be part of the adjustment here. But doesn't matter. In this particular illustration, we do the long cut first. Wrong. 520. We take 80% there off. And then for the impairment loss, we also take an 80% there off. So we will have this figure. Okay. For beta B, very direct only, 25% of the post-acquisition reserves. Okay, so since over here, impairment loss, the holding has taken the 80%, which means that 20% of it will go to the NCI. This is the balance. 80% times by 100, 20% times by 100. Okay, this is from the goodwill computation. This is the share of the post-acquisition retained earnings, share of the post-acquisition ARR. This is your share of the impairment loss. Okay. This one, just remove the pre, then you share for the console ARR. This is the apportionment of the profits for the year and the total comprehensive income that should appear in the console SOPL. Okay, maybe now we are almost done with respect to the console SOFP. Okay, so we will now just quickly have a look at the console SOPL. So console SOPL, as we have mentioned, 1,300 over here is the intra-company sales. Then you minus the intra-company sales. 24 is what? The URP, let me just see. This is the net W8. So this is the net. This is 42 plus 42 of the closing inventories URP, and then you remove the 18, which is the opening inventories URP. Then you will get to this 24 plus 24. This particular 10 is the additional depreciation. Additional depreciation. Okay. And then this 25 is the impairment loss on goodwill. Let me just go up. Did I make a mistake here? Oh, this one shouldn't be 40. Okay, this should only be 10 because 40 is for 4 years. Where is it? 40 is for 4 years. And since you are going to prepare the console SOPL, you only need to take for 1 year. So this should be only 10. Okay. But at the console SOFP, you need to minus 40 cumulative because console SOFP is always SAT. SAT means it's cumulative. This one, SOPL, is for 1 year. So it's only for 1 year. This is only impairment loss for the current year as well. This 87 is the intangible assets that was wrongly capitalized, okay? And then your share of profits from the associate. This is the evidence of equity accounting, okay? Then the rest should be not much of an issue. So now we want to look at W7. How do we attribute the profits between the parent and the NCI? So you can look at here. These are the figures taken from the question. 616 from the question. OGAF profit for the year. So we are going to take profit for the year. Okay, this one is the TCI. So you take TCI 616, 621. So you can see or not, if I am the marker, I'll be very upset. Why I need to keep on scrolling up and down, up and down. Okay, then after a while, you also don't know where you're supposed to scroll to. That's my W7. Okay, 616 and 621. Okay, what are those figures that you need to put into here? What are those figures that you need to adjust here? How do you know that they need to be adjusted here before you take the NCI share? All right, whatever adjustments that you have made in the console SOPL that affects the retained earnings of the subsidiary. Okay, what are those adjustments? So the first one is impairment loss law. Okay, and always remember what you adjust in the console SOPL is always for the year. So you have to take for the year's impairment loss. The URP, because this is what we call the upstream transaction. The startup cost, which is the intangibles that was wrongly classified. Then the 1 year's additional depreciation because of the fair value adjustment. So everything you minus. Okay, then you get 470, you take a 20% there off. So usually whatever adjustments that you make at the profit for the year will be duplicated to here. Okay, so you can see that they are the same figures. So you are going to get 95. 94, 95, NCI's figures. So 94, 95. Whatever is it, is the balance goes to the shareholders of the parent company. Okay, because a lot of times the student will do until here. But this one, not yet finished one, no. You still need to do the OCI component. Then you still need to attribute the profits. 2 times attribution. This is for profit for the year. Profit for the year. This is attribution of the TCI. Okay, so I will leave it to you to go and have a look and reconcile all the figures from the workings here to go to the console. Okay, so you can see like workings number 8. Workings number 9, workings number 10, usually not necessary. Because if you were to do this, it will take up some time as well. So not necessary. You can just do the simple calculation and then put it by the side of it. Okay, then we'll do already. No need to refer W12, W8 and so on. Okay, so this will be with respect to Otway Group. And then, of course, we always say that disclosures of interest in other entities. So, of course, the group financial statements will ask you to do a certain disclosure to the notes to the financial statement. So basically, it's to enable the stakeholders and or the users to evaluate the nature and the risk associated with the interest in the other entities. Okay, so this will be the last part with respect to here. And then we continue on with the next one. This is the PowerPoint slides, yeah? PowerPoint slides. The PowerPoint slides of which Edwards we have already discussed. Okay? Edwards we have already discussed with respect to the three characteristics that must be there to determine whether or not Edwards controls hope. Okay? And then this is the Bailey question. So this is the PowerPoint notes that I've given to you earlier. So can you look at the PowerPoint notes? And I have, if I'm not mistaken, left blank, 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 and blanks for you to work out the workings. Okay, so maybe what you can do is work out the workings for goodwill, investment in the associate, and the reserves. Okay, I think NCI also you can do that. Okay, 1, 2, 3, 4, 5. Can I give you some time to look at it because it's the same, not to say it's the same, almost the same as the Otway question. Okay, so first of all, you have to look at this, put down what is the date of acquisition, what's the date of consolidation, how many percent, and so on. Whether or not, when this particular figure is given to you, do you have any fair value adjustment upwards? Okay, so I give you about 15 minutes to look at it. You fill in wherever possible. At least look at some of those additional information because they are not difficult ones. All right, calculate 1 or 2 of them. Okay, 15 minutes. So we will discuss at 10. Any questions so far? Any questions so far? No, Okay, so I leave you time to go and look at the question. So you try to look at the question on your own while I do something to the facts given as well. All right. So do not be alarmed because that I will just mute my mic because I'm not talking at that time. Okay. So you try to do the question, and then later on we will have 2 more questions to look at. Maybe I will not go into very detail for this one also because it is quite similar to Otway. We will just look at some of the adjustments, and like I mentioned just now, the shortcut as to where to put the impairment loss when NCI is measured at fair value. Okay, then thereafter we will look at Pankerf and Spear and South Star, Polestar and the South Star, and then maybe another one more. Okay, just to look at the peculiarities of certain adjustments. Okay.
Miss, you mute your mic already.
Yeah, I haven't started. I haven't started talking. Just now I mentioned already. Thank you. Okay, just now I was just writing because you're doing your part, ma. Okay, now I am unmuted. Okay, so now we will start to do the explanation. This will go to the console SOFP. Okay. Yep. Just now was for you to do your work, so I muted. So now I will do the explanation. You just check back against what you have done in the last 15 minutes. So this particular table that is given to you, first thing, like I mentioned, you have to put down what is the date of acquisition. And over here, the date of acquisition is already given to you. Okay. And then the date of consolidation, either you look at the question, which is on 31st December 20X9, or you look at the data that is given to you here. Okay, the question 31st December 20X9. So you're supposed to prepare the console SOFP, console SOPL, OCI. Okay, so more or less the same like just now the question of the odd way that we have done. So which means that we have to find out what is the duration from the date of acquisition to the date of consolidation. So over here, 4 years in Hill. In Campbell, it is only 8 months out of 12 months. So this is the one that you have to be a little bit careful because the question actually asks you to prepare the console SOPL. So when they ask you to prepare the console SOPL, which means that you have to be careful a little bit. Okay, even though this is as an associate, but remember you also need to equity account. Every time you take any figures from the column of the associate, you have to times by 8 out of 12. So that is what I usually tell the students. The moment you find that the date of acquisition to the date of consolidation is less than 1 year, you go and put at the SOPL only, SOPL. Put there times 8 out of 12. Okay, but if you are preparing the console SOFP, there is no necessity to prorata, even though it involves the subsidiary. Understand? Because SOFP do not need to prorata. SOPL, yes, because this is for the year. Like I say, for the 1 year. The one is silent. Okay, but when you say SOFP SAT is always cumulative from last time until today that means it's cumulative one. Okay, then you have a look at this data. Remember I say if the fair value of the net asset at the date of acquisition is given to you, which means that you have to go and reconcile. 500 plus with the 440, does it give you 1040? If it does not, then there must be some fair value adjustment upwards. Okay, some figures that you need to insert in so that they reconcile. Cost of investment, although it is given to you here, it is good for you to reconcile to the SOFP given to you. Just make sure that the two figures tallies. 720,225, betul. Then this is for you to calculate how many percent is the Bailey's so-called acquisition in Hill in Campbell to know what is the status. So Hill is actually a subsidiary. Campbell is actually an associate. Subsidiary, consolidate. Associate, equity account. All right. This is just a shortcut way to find out how much is the goodwill in your investment in Hill. Because over here, all the figures are given to you. This NCI figure is given to you in the additional information number 3. They tell you 450 million. So you can just very quickly gather the information given. This one, 1040. But of course, like I say, this one, it will be good for you to give a breakdown. Ordinary share cap 500, RE 440, fair value adjustment upwards 100. Then you get 1040. So, Champotola, you're going to get the goodwill of 130. And just now, additional info number 4 tells you about the 20 million of cumulative impairment loss for your investment in Hill. So you will have to show the impairment loss, and therefore to the console SOFP, you only have 110 for the goodwill. Okay, so of course this is preliminary only lah. Then thereafter they gave you the draft. So this one, okay, double check already, no problem, no problem. Equities, no problem. Then SOPL, also no problem. But remember, associate, you have only 8 months into the year. Okay, then if you look at this, dividend income from Hill and Campbell. So remember, like I say, if they are so kind to you as to put dividend income from Hill and Campbell, so you know that this particular figure will never go to the console SOPL, but it will be good for you to reconcile. So here's 36, right? So then you look at this one, dividends paid by the subsidiary, Hill and Campbell, the associate. Campbell, this is Bailey. Okay, so to Bailey, Bailey has 60% interest. So 60% times by 50, you get 30 million. And then 20 million is the dividends that was paid by the associate. And Bailey has a 30% share. So 30% times by 20, you have 6. So 30 plus 6, 36. Just nice offset this particular dividend income from the brothers and sisters. Okay, so other than that, there is nothing much. This one also nothing much. Okay, so which means you can look at the additional information. Of course, the additional information, you would have looked at it earlier as well before you start to compute the goodwill, right? Okay, so this one, they tell you about the fair value adjustment upwards for the PPE, which is 100, 100. Okay, 100. So which means this will actually have additional depreciation for 4 years. Each year is only 10. Okay, and then item number 2 talks about intra-company sales of inventories. So usually, even though F7, they ask quite a lot about URP adjustments, but I would find that in SBR, usually they also have 1 or 2, just a simple one. And then, which means that URP adjustments, you must know how to do. Otherwise, this is considered the simpler kind of adjustments. And then if the simple one also, you cannot get the marks. What about the difficult adjustments? Okay, so remember how to see. First, the intra-company sales must be in the post-acquisition period. So during the year ended 31st December 20X9. So of course, this is already in the post-acquisition period. Hill sold 200 million. Hill sold. So Bailey is the holding, Hill is a subsidiary. Hill sold. So your arrow is pointing upwards. So this is upstream transaction, which means that should you have any URP, you need to adjust from the books of the seller. In this case, the seller is Hill. So which means the URP, you have to offset under the retained earnings under the column of Hill. Okay, so they tell you 3/4 of the goods have been sold. So which means when we want to calculate the URP, we need to calculate for the unsold inventory. So which means the URP computation will be what? Value of the inventory that remains unsold. 3/4 sold, unsold will be 1/4. 1/4 out of how much? Out of the 200 million. Okay? 3/4 have been sold and the profits was 40% on sales price. 40% on sales price means that you just need to times by 40% because on sales price means margin is given to you. Okay, so this will come up to how much? 200, 1/4, 40%. So this will come to 20 million. From whose books you need to adjust this 20 million? From the books of the subsidiary. Okay, so sometimes you have to be careful. Sometimes the question tells you 3/4 remain unsold. Or like in this case here, 3/4 have been sold. So the unsold must be the remainder. You get what I mean now? Sometimes they will tell you on the selling price, on the cost, then you must adjust accordingly lah. And in this question, they tell you there were no opening inventory. So this is good lah. So this particular inventory's URP is actually the closing one. Okay? Then, of course, this one, item number 3, we have already taken it into account, which is the NCI in Hill at the date of acquisition. And since they tell you at fair value, which means that any impairment loss thereof, you must share. Okay, because you have taken full goodwill into the books, which means that any impairment loss thereof, you must share. Impairment loss, you share between the holding and the NCI. Okay, and item number 4 tells you about how much is the impairment loss in total. Up to today, it is 20 million. And they tell you out of this 20 million, 15 million arose during the current period. So that means you need to split because this is the figure that will go to the console SOPL. The total, you have to knock off from the goodwill before impairment to bring to the console SOFP. Okay, then they tell you no impairment losses is necessary in your investment in the associate. So this one shouldn't have much of an issue also. All right, just quite similar to the earlier one. It's just that when you want to take the share of profits from the associate, remember, every time you take the figure from the column of the associate, you have to times by 8 out of 12. Where did we get this 110? We go and look back at the question. Campbell, 110. This is profit for the year. Okay, so when you take the figure, must remember to see the under the Campbell got times 8 out of 12. So you need to times by 8 out of 12 times by your share. Okay, 110 times 8 out of 12 times by the holding company share. All right, the rest of it I think should be quite simple. You see, again, when you take the share of gain of the property revaluation of the associate, you have to times by 8 out of 12. All right, but when you prepare the console SOFP, there is no apportionment one, okay? And the figures of the associate does not come to the console SOFP because they are only equity accounted. So if they're equity accounted, you will see an investment in the associate in the console SOFP. Okay, rest of it, I think you can reconcile the figures later on. Now, I just want to bring your attention to, of course, this goodwill, I think no issues. Investment in the associates, also no issues. To the reserves here. Okay, So these reserves, I don't know how many of you have done it, but if you look at it, this particular one is the reserves. Okay, so what are those figures that we would have taken to go and prepare this particular workings? These are all direct from the question, from the question, from the question. Okay, basically these two are the same. I just want to show them side by side, how you can account for this impairment loss in the goodwill in Hill in a shortcut manner. Okay, because for Campbell there is nothing so there is nothing to show. Okay, so these are the figures extracted from the question. And then remember, in Hill, you have some fair value adjustment upwards that attracts additional depreciation for 4 years. So this is the additional depreciation of 40 million. And remember just now, we have computed the unrealized profit. And because it is upstream, we will minus it under the column of the subsidiary. And of course, this is just the pre-acquisition portion. So once you get this 1,003, you just take a 60% thereof to go to the holdings. Then for the associate, you are going to take a 30% thereof. Okay, then remember just now we mentioned that impairment loss is 20 million. So you need to share impairment loss. Where is it? Impairment loss of 20 million, you need to share, all right, between the holdings and the NCI in the proportion of 60-40 right? So 60% will be absorbed by the holding, which means that later when you prepare the NCI, 40% of the impairment loss will be taken to the NCI portion to knock off against the NCI. Okay? So at the end of the day, this is how much of the figure with respect to the GRE that will go to the console SOFP. All right, 4216. But remember just now, I did mention that sometimes if you find that the NCI is measured at fair value and you have impairment loss, so what we do is that we can do a shortcut. Where is the shortcut? Over here. So this particular impairment loss, we will put it under the column of the Hill so that we can get a revised post-acquisition RE in the subsidiary. So once we get that, we are going to take the normal one, 60% thereof. Okay, so if you were to insert the impairment loss to come out with the adjusted post-acquisition RE in the sub, we just need to do the apportionment once only. Okay, so this one we get 768. But over here, we do it 2 times. One is because we didn't put the impairment under the column of the Hill, so we have 1,300 we apportion, we get 780. And then we apportion again the holdings share of the impairment loss. So when you take these two together, 780 minus 12, you basically get back 768. Understand? So that is why we always advise the student, if the NCI is measured at fair value, like in this case here, the impairment loss, we are going to insert it. That means insert it so that we just distribute once. Because sometimes you do this already, then you forgot about the impairment. Most of the time, we have seen many students, if they don't do it this way, many of the students will forget to share out the impairment loss. So in order not to forget, so we will tell you, if the NCI is measured at fair value, and should you have impairment loss, so impairment loss, you insert it under the column of the subsidiary to get to the adjusted retained earnings post acquisition. Then you only need to do the apportionment once. So that is why you don't need to do this anymore. So which means the same. If you have already apportioned so much to go to the holdings, then the balance 40% will go to the NCI. So for the NCI, the Scully Goods take 1280 times by 40%. So you will show as 512 to the NCI. Understand? So otherwise, if you do it this way, then it will be what? To the NCI, you take a 40%. So it will be what? 1,340%. So it will be 520. Then this 520, you need to minus out the share. 40% share of the impairment loss. So this will be 8. Net, you still get 512 to the NCI. Okay, so you will see this figure and this figure will tally. All right, so easiest would be what? You try to use this particular method. Okay. Let me just show you the answers. This particular slide later I will share it with you. This has all the answers. So this is on the adverts. Adverts we have already done. This one has all the answers. So later I will share with you. Okay, for the workings. All the workings here, there are answers. Right? Any questions with respect to this one? Of course, the other figures you can reconcile. They are not difficult to reconcile anyway. So if you're okay, no questions on this, I want you to have a quick look at the files section. There is a folder on class number 5, which is today. So you will see 2 templates being uploaded. One is on Pancurve and Sphere, another is Polestar Southstar. So if you look at the template over here, okay, because the question on Pancurve and Sphere, I have already given to you much earlier, okay? But since we are going to discuss this, I have cropped whatever that is necessary from the question, and then we are going to look at the adjustments, okay? Can So now we will look at Pancurve and Sphere. So, I mean, you can download this particular template and then fill it in as and when we have looked at the adjustments. So they are found under the file section for class number 5. Okay, class number 5, you will find the 2 files there. So let me call out the files. This one no need already. We have the question on the Pancurve and Sphere. So Pancurve and Sphere, this is the past year questions with respect to F7. Okay, which means that if you are exempted from F7, which means that these types of questions, you must know how to do one. Okay, so this is the question. And then I have transferred this to the Excel. Let me see. Excel. And see them side by side. Okay, so you can see these two side by side. So maybe give you 5 minutes to have a quick look at the question. So you try to fill up the template with respect to the basic ones. What is the date of acquisition, the date of consolidation, how many percent acquired, all right? And then we are supposed to find out how much is the cost of investment, and then some fair value adjustments from each of those parts. So you can see that all these parts, I have already extracted them and put it down here so that we can explain later. And then you probably have a homework for you to do, take home homework, do whenever you have the time, and then submit. So the submission will be via the MS Teams. So later I will post up, create one submission box, and then you just submit and then I will look at it and then return. Okay, so have a quick look at this. You just fill in wherever you can. So first day of October, Pankow acquired 90 million shares of 90 million of Sphere's 150 million equity shares. So you have the date of acquisition, which is what? First day of October 2013. Date of consolidation, I say, if you don't want to look at the question, you can actually look at the financial statements given to you. So this is on 31st March 2014. Okay, so once you get these two dates, remember we say we have to see how long is the duration from the date of acquisition to the date of consolidation. So here is only October. So October we count October, November, December, January, February, March. So we are only talking about 6 months into the year. So which means what must you do? Remember I said this morning, just now, oops, you are supposed to go and put big times by 6 out of 12. Okay? Because this is with respect to the SOPL. So this is SOPL OCI. So whenever you take the figures of Sphere, you have to times by 6 out of 12. Okay? How many percent was acquired? 90 out of 150. So which means you acquired 60%. So when the holding acquired 60%, since there's only one company, the other 40% must belong to the NCI. Okay, so this was the figures that we need to extract at the onset. Okay, then maybe we can close this part because I already transferred the information from here to here. Okay, so that we can have a bigger font to look at. Okay, then we will come back to that one later. Okay. Okay, so we have already got this particular information. 60%, which means that Spear is actually the subsidiary. Pankow is the holdings. 40% belongs to NCI. The duration from the date of acquisition to the date of consolidation, only 6 months. And then these are the instructions with respect to how this Pankerth pay for this particular investment in the subsidiary. So they actually tell you what. Let me see. Okay. So this is the date of acquisition that we have already extracted just now. Okay, so now the acquisition was achieved through a share exchange, 1 share in Pankerth for every 3 shares in Sphere. How many shares did Pankerth acquire in Sphere? 90 million. So which means share exchange will be what? 90 million numbers of shares. Every 3 shares in Sphere, they will give you 1 of Pankerth shares. And how much is the market price of 1 of Pankerth shares? At that date, the stock market price of Pankerth and Spear shares were 4 and 250 respectively. So this 4 must be for Pankerth. So in other words, here you have to times by 4. Okay? And they tell you what? Additionally, Pankerth will also pay 1.54 cash on 30th September 2014 for each share acquired, and the finance cost is at 10%. So when you look at this, today you acquire, but then there is another cost of investment at $1.54 per share acquired, and that will be paid on 30th September 2014. So which means 1 year later, not pay now. So in other words, this is a deferred payment. For a deferred payment, we have to do what? For a deferred payment, we have to present value. So which means first we find out how much we need to pay. $1.54 for every share acquired. They acquire 90 million numbers of shares. And then if we need to present value, we go on what? 1 over 1 plus with R. In this case, the R is 10%, 0.1. And then to the power of when we have to pay 1 year from now. Okay? So that will give us some figures for the present value. And then remember, if you present value the deferred payment, what must you remember? Later, you must do unwinding of interest. Unwinding of interest. Okay? This one we must remember lah. Later, you have to do the unwinding of the interest. Okay? So this one will amount to how much? You can calculate. You are going to get 120 million over here. 120 million. And then the present value of this particular deferred consideration will come up to 126 million. So at the end of the day, 120 plus 126, your cost of investment is 246 million. Okay, so this is what you have gotten. So now if we need to calculate the goodwill, we need to get the cost of investment first, right? Because the question here, the first part of the question, they ask you to calculate the goodwill. Where is the first part? Calculate the goodwill on consolidation. Okay, so we already gotten the cost of investment. And then because this is an acquisition during the year, 6 months out, 12 months, so which means we usually we need to calculate how much is the retained earnings at the date of acquisition. And usually, if you need to calculate that, usually they have this particular note given to you. what is the note that will always be written? All items in the SOPLOCI are deemed to accrue evenly over the year unless otherwise indicated. So which means you can prorata the expenses, the income, whatever that appears in the SOPL, everything can prorata proportionately over the period. Okay, so in other words, we can find out how much is the retained earnings pre-acquisition. So what did they tell you? Retained earnings brought forward on first day of April were 120. So we will transfer it to over here. Retained earnings at the beginning of the period. Okay, so you can see over here, this info given to you. Retained earnings on the first day of April, 120 million. Our task is to find out how much is the retained earnings on this date, because this is the date of acquisition and this is the date of consolidation. Okay, and from the question just now, we know that profit for the year was 80. And when you take the figure from here, this is for one whole year. Okay, so what do we do? For the whole year, the profit is 80 million. But we know that we only acquire the interest in a subsidiary in the last 6 months. Okay, so last 6 months, the first 6 months. Okay, because here April, May, June, July, August, September is 6 months. Oh, 6 over 12. Okay, this is also the same. All right, so 6 months, 6 months. So which means this is the date of acquisition. How much is the profit during this particular time frame before it was acquired? So in other words, 120 must be pre. So you have to apportion from the 80 million, you take 6 out of 12. Okay, so that will give you how much? 40, 40, 120, 160 million. Okay, so if you've gotten this, that means you should be able to proceed to calculate the goodwill already. Okay, next item, they talk about the fair value adjustments. So a fair value exercise was conducted on 1st October 2013, concluded that the carrying amount in Sphere's net assets will equal except the following. So there is some fair value adjustment upwards with respect to the land. How much was it? 2 million. 2 million upwards. Okay. Then an item of plant had a fair value of 6 million in excess of the carrying amount. So this item of plant upwards 6 million. And then the plant had a remaining life of 2 years at the date of acquisition. Plant is charged, the depreciation of the plant will be charged to the cost of sales. So when you want to calculate the additional depreciation, it will be how? 6 million divided by 2, correct or not? And then for this particular, what do you call that, consolidation, you only need to provide depreciation for 6 months. So 6 million divided by 2 times by 6 over 12. So this one, you're going to get additional depreciation of how much? 1.5 million. Okay, then you have the next one. Pencroff placed a value of 5 million on Sphere's good trading relationship with its customers. Pencroff expected, on average, a customer relationship will last for a further 5 years. Amortization of the intangible assets will be charged to the administrative expenses. Maybe this one we should put it on the same line here. No space. 1.5 million. Okay. Then we have additional amortization will be equal to how much? So over here, 5 million is the fair value adjustment upwards. Okay, so they tell you additional amortization. How much do you get? Additional amortization, you also do the same over a further 5 years, and then you know that this one you need to apportion. So additional amortization here, 1/2, 0.5 million. Got that? Okay, so which means when you want to calculate goodwill, 1, 2, 3 must be taken into account. But this additional depreciation, additional amortization is a post-acquisition adjustment. So when you want to compute the goodwill, you don't have to take into account this. Okay, then what else we have? Next one. Panker's group policy is to revalue land to market value at the end of each accounting period. Prior to its acquisition, Spear's land had been valued at historical cost, but they have adopted the policy since its acquisition. The additional fair value increase in Spear's land of 2 million. This is the one, the 2 million, and it has increased by a further 1 million since acquisition. You see, this particular fair value adjustment upwards is done at the date of acquisition. So this is pre. And then in the post acquisition, they have gone up by another 1 million. So what happens? The pre will be eliminated when we calculate the goodwill. But the post, later on, you need to share. Share with the, that means this is post acquisition, right? Share with the NCI in a proportion of, how many percent was that just now? How many percent do you acquire? 60. So which means 60, 40. 60% to the holding, 40% to the NCI. Okay, because anything that is post-acquisition, you have to share. Pre-acquisition, no need to share. You eliminate already. It's just like sometimes the people say, before you got married, whatever that you have belongs to you. But after you got married, everything that you have, you need to share. Okay, that's why sometimes there are also some people that says, ooh, what is all this? Okay, 60% versus 40%. That's why some people say, all right, you can be a millionaire if you marry the right person. Then after that, you get a divorce, then you get half of the property of the other person. Okay, so, that is a shortcut way lah. All right, so for this particular post-acquisition ARR, you have to share. 60% will go to the console as consolidated ARR. The 40% will go to become part of the figure in the NCI. Then you have the next, Roman 3. On first day of October 2013, Panker acquired 30% of Ventor's equity shares. So this was done on 1st October 2013. 1st October 2013. So which means our consolidation is still the same date, which means that it also has a 6 out of 12 months period since the date of acquisition. Okay, so they tell you their profit after tax for the year ended 31st March 2014 was 10 million. Okay, so which means since Panker has a 30% share in Ventor, Ventor is Panker's associate. So they must also have some share of the profits from the associate. So which means how much is the profit? 10 million. But you know that you only acquire the interest 6 months into the year. So you have to pro rata in accordance to time frame. So which means 10 million times by 6 out of 12 times by 30%. So you have 1.5 million here. Share of profits from the associate. So you also have some dividends because during the year of 2014, Ventor paid dividends of 6 million. So when they pay dividends of 6 million, you as the 30% shareholder, you also will get the sum of the dividends. So you're going to get dividends that is worth 1.8 million. Got that? Okay. But Sphere says, oh, I didn't pay any dividends in the particular current year. Then you have this item number 4. Item number 4 is your URP calculation. Okay, so the URP calculation, like I say, you should know them at fingertips. Okay, between the holding and the subsidiary is quite simple. Panker sold goods. So Panker is here, Spear is here, they sold goods. So it's downstream for 20 million. So in other words, intra-company sales and purchases that you need to eliminate will be 20 million. 1/5 of these goods are still in the closing inventory. So of the 20 million, 1/5 is still part of the closing inventory. And then the other one is with Ventor. So later, all sales to Sphere and Ventor had a markup on cost of 25%. So when markup is given to you, you take the markup over the invoice price. So you have 20 million times by 1/5 times 25 divided by 125. So over here, the closing inventories URP is 0.8 million. So can you work out how much is the closing inventory with respect to the intra-company sales between Pankerth and Ventor? Also downstream, right? 15 million, all of which were still in the inventories at year end. So which means 15 million times by the markup given 25 over 125. And remember, because this is with the associate, you have to do partial elimination. How many percent was the interest in the associate? 30%. So you need to times by 30%. So 15 times 25 divided by 125 times by 30%. So you get 0.9 million. And this one is just the journal entry because since this is downstream, which means the profit you have to eliminate from the books of the parent. So you offset from the GRE, this particular 0.8 million. Then the inventories are in the books of the subsidiary, isn't it? And subsidiaries figures you do consolidate. So you still need to remove the URP from the closing inventory that is appearing in the books of the subsidiary. Then over here, the profits must offset from the books of the parent. So we offset it from this particular GRE, and then because the inventories that appears in the books of the associate is not consolidated because associate we equity account. So the only way to show that we are removing the URP from the closing inventory is to credit it from the investment in the associate. Okay? So which means when you prepare the T account for the investment in the associate, you will have one figure on the credit side that says URP 0.9 million. Right? And then item number 5, Panker's policy is to value the NCI at the date of acquisition at fair value. So how do they measure the NCI? At fair value. So if you measure at fair value, so which means what? Later, when you have impairment, the impairment will have to be shared. Okay, but in this particular question, they didn't give you how much is the NCI at fair value, which means you need to compute by yourself. What is the value of NCI at the date of acquisition at fair value? So you have to take what? Number of shares held by NCI times by subsidiaries share price at the date of acquisition. Okay, so how many numbers of shares are held by the NCI? Numbers of shares held by the NCI, you go back to the question. 90 million out of the 150 acquired by the holdings. So which means you take 150 minus 90, which is 60 million, will be acquired, will be the shares that belongs to the NCI. And then they tell you $4 is the Panker's share price at the date of acquisition. Sphere's share price will be 250. So this is the one that we wanted. Share price of the subsidiary at the date of acquisition. So we can now calculate how much is the value of the NCI. Okay, so which means we are going to get 60 million numbers of shares times by, how much was it? The share price at the date of subsidiary at the date of acquisition, $2.50. And then you're going to get to 60 million times by 250, you're going to get to 150 million. Okay, you got that? So this will be the figures that you are going to get to help you compute your goodwill. Okay, then of course the last one just tells you that, oh, if you see this particular kind of additional information, so in other words, they're telling you that you be careful. You have to check whether is it a situation of an acquisition during the year. Like in this case, yes, we know that this is a situation of an acquisition during the year. Okay, so with all these, you should be able to compute the goodwill as required by the question. Okay, this one, I think no need to save, right? Because I also just work it out, no need to save. Okay. Maybe I should just print a copy. Print. Just want the. Let me just crop it first. This one. Yeah, some of the figures over the other side. Okay lah, never mind. I just save it first. Later I will crop it nicely and then put inside the file section. Okay, so now that we have already analyzed the question, we can now look at how much is the goodwill computation, because we have already looked at all the figures already. So you can see over here, these are our computation. Just now we have worked out at the Excel. So total of the cost of investment is 246. And just now we have worked out the value for the non-controlling interest at fair value. So the figure is taking what? Numbers of shares held by the NCI times by the subsidiary share price at the date of acquisition. So you have this 150,000. This plus this, you get this and all this. This one is to get to the 160, which is the pre-acquisition RE. And then the fair value adjustment with respect to land, plant, and customer relationship, you campur tolak, then you get the goodwill of 73,000. Do you get that? If you have worked out, you should have gotten that also lah. Right? Did anyone work out until there? The other also. Okay, never mind. The next question, you can work it out. Okay, so you get 73. So of course, the question didn't actually tell you that there is any impairment. So the 73 will actually go to the console SOFP. Okay, but of course, in this question, they do not require you to prepare the console SOFP because no data given to you, okay? So we have a quick look at all these. What are all these kinds of adjustments? So I can still look at this. These are the answers. This is just a pro forma. This one, maybe we have to put it a little bit smaller. This is the pro forma, okay? Because sometimes, of course, if we just look at the figures, then it serves no purpose, isn't it? So you know what times what, But remember, there are certain rules because like in this case, we are preparing the console SOPL. And we know that the subsidiary was acquired only 6 months into the year. So which means all the figures of the subsidiary, if you were to take it from the books of the subsidiary, you have to prorata. Why? Because you're preparing the console SOPL. Okay, then that will give you the first figure holding plus with the subsidiaries figures, you prorata. And then you just need to eliminate the intra-company sales. All right, so if you look at it, this is what the brief description is. These are the rules. Okay, then you see the cost of sales. Instead of you going to look and do another schedule, W1, okay, W1. So you probably just do a simple one, okay? So you have holding, you have subsidiary. When you take subsidiaries figures, always remember to prorata. Intra-group purchases, this will be the same as the intra-group sales figures. Additional depreciation, this is put down here because the requirement of the question says so. Okay, so that's why here I didn't put also. Okay, then unrealized profits on the closing inventories. So you need to put them in here as well. So you just gather 458, 200 and place it down here. Others will be okay because if you see distribution costs, you just take from the subsidiary, you times by 6 out of 12. Expenses for administrative, you also do the same. And then this one is the amortization. Okay, the amortization of the customer relationship. But you also need to apportion in accordance to time basis. Then you have the next, share of profits from the associate. Okay, and then you have also investment income in the question. And this particular investment income that is given in the question, they didn't say that the investment income is only from SBR. So, which means you need to work out. All right, how much is it that you need to offset? So of the 5,000, 1,800 is from the associates dividend. Okay, so you need to remove, and then whatever income, you need to take 6 out of 12. Okay, and then remember, you need to do the unwinding of the interest. And when you do the unwinding of the interest, you need to prorata also according to time. Okay, and just now we have seen with regards to the ARR. So they tell you that, there was some loss on the revaluation of the land. But then we know that we need to remove the pre-acquisition fair value adjustment. All right, then only the remainder will remain in the console. Okay, attribution of profits to the NCI, just now we have seen already. Okay, so this will be the skeleton. So which means over here we have this, and then we also have another one, which is additional depreciation because of the fair value adjustment. Okay, so later, if you want, I can just put this at the files section. Any question with regards to this pancurve and sphere? No question? If no question, then we move on to South Star and Pole Star. Okay, South Star, Pole Star. Pole Star, South Star. So since we have looked at so many types of basic console questions, so I think that for here you should be able to do the questions. This is almost the same one, huh? So can you try and do it? Pole Star, South Star, fill in the figures, and then calculate the cost of investment. Tell me what is the fair value adjustment upwards and the additional depreciation. Calculate the URP, and then do the fair value, financial assets recorded at fair value through the profit or loss. And then in this case here, you also need to compute the NCI at fair value. Okay, let me just show you what was the question. So this question we don't want already. Take the other one. This is your Pole Star and South Star. Okay, you look at this one, give you some time to look at it, and then you can go for a toilet break. We will continue at 11:15. You fill up the template, yeah? 11:15. You can go for your toilet break, and then you call up this one, the file, and then fill in wherever possible for the Pole Star and the South Star. Okay, so give you some time to look at it, fill in wherever possible. The only question that I think is a little bit difficult will be the Roman 2. Okay, because this is something that is peculiar. Other than that, the rest of the adjustments you should know how to do. So I'll give you some time. Once you finish already, maybe someone can crop the first part All right, and then put it in a meeting chat. Cost of investment also you can calculate and put at the meeting chat. Okay, so I also don't know whether you people are following me or not because there is no response when I ask the question. All right, so hopefully after you've taken a short break, then you can do something. Okay, we will continue shortly. Yeah. Anyone has completed the initial few details just to put down what is the date of acquisition, what's the date of consolidation and stuff? No? Just cut and paste from whatever that you have filled in to the meeting chat. So at least you can do some participation kind of stuff, rather than I do all the talking. And then I also don't know whether you are with me or not. Anyone? I still got time, yeah? 5 more minutes. Right, since no one has cropped anything from what you have done, so I will just proceed to discuss this. Okay. So I have opened up the template from the file section so that once I write it here, then it will be auto-saved. So what do we have? So since I open here, it's a little bit difficult for me to go and share the two sides of the screen. So basically, I will just look at the question and then extract the figures to be put here. Right? So we have Polestar and Southstar. When you look at the question, they tell you on the first day of April 2013, which is from the question, 1st April 2013, Polestar acquired 75%. So, which means that over here, the percentage of acquisition is 75%. 70. Why cannot? Let me see. Type the text here. Why cannot? 70. So here will be 75%. Okay, so if the percentage of acquisition is 75%, that means 25% belongs to the NCI. Okay, so what was the date of acquisition? So in this case, given to us, date of acquisition is 1st April 2013. What is the date of consolidation? How do you see? You just need to go and look at the question or look at the data that is given to you. So this is 30th September 2013. So when you look at the date of acquisition to the date of consolidation, then it's in the same year, right? So which means that you could have an acquisition during the year. So how many months? April, May, June, July, August, September. So it is for a period of 6 months out of 12 months. So which means that every time you're going to take the figure from South Star, you're going to take times by 6 out of 12. Okay? And then in this particular paragraph, they also gave you with respect to the cost of investment. So they tell you 75%. Okay, Southstar had difficult trading conditions and is making significant losses. In allowing for Southstar's difficulties, I think the thing didn't come out properly. So in allowing for Southstar's difficulties, Polestar made immediate cash payment of $1.50 per share. Okay, so you have to look at how many numbers of shares there are in this particular question. So you will find that over here, how many numbers of shares you have, because each share is 50 cents. Of course, this one was the previous questions whereby they still have par value. Otherwise, we should always put down they would always have another place whereby we are going to put down the numbers of shares. So number of ordinary shares, where we are going to put all the way here, since they are 50 cents, so that means here will be 60 million numbers of shares. Here will be 12 million numbers of shares. Okay, how do we get that? Because 12 million times by 50 cents, only you get to the 6 million. All right, so which means 12 million numbers of shares. You acquire 75% of it. Okay, so they tell you $1.50 for each share that you acquire. So that will be the cash component, 9 million, because 12 times by 75 is 9 million. 9 million times by $1.50. Okay, and we go back to here. And then they tell you what? They have $1.50 per share. And then in addition, they pay a further amount in cash on 30th September 2014 if they return to profitability by that date. So which means what? This is what we call the contingent consideration because there is a so-called a condition that is attached. So they tell you, now we pay you so much in cash, but subsequently, if your status returns to profits, then we will pay you further amounts. Okay, so that particular further amount in cash is what we call the contingent consideration. So once we have put this particular contingent consideration, then we have to add fair value of the contingent consideration at the date of acquisition. So it was 1.8 million. So the value of this contingent consideration at the date of acquisition was 1.8 million. So we need to take the 1.8. So after that, you plus everything already, you will have 15.3 million as your cost of investment. Okay, is it? Yeah. So that one was 9 million times by 150 and then plus with the 1.8 million. So you got 15.3 million. Okay, and then also the question has given to you that, you know, subsequent to the date of acquisition, there has been, what do you call that? In light of the continuing losses, at the end, when you do the consolidation that time, the fair value of the contingent consideration has gone down to become 1.5 million. So which means that what? You're supposed to pay 1.8, but then later on, because of the continuing losses of the subsidiary South Star, you find that, oh, this particular contingent consideration that I have to pay would decline. So in other words, there will be some kind of windfall gain. So decline in the fair value of the contingent consideration will be treated as a windfall gain. So in other words, the difference will be 1.8 versus the 1.5. So 0.3 million as the windfall gain. Okay, got that? Then we have the next one. At the date of acquisition, fair values of South Stars were equal to the carrying amount, except for some leasehold property. It had a fair value of 2 million above the carrying amount. So which means fair value adjustment upwards is 2 million. And then they tell you that lease term is 10 years. And this particular depreciation is to be included as part of the cost of sales. So which means you take the 2 million divided by the 10 years, and then remember you have to pro rata in terms of the depreciation, and then you are just going to arrive at 0.1 million. And this particular figure, you are going to take it as part of the cost of sales, okay, as required by the question. This is the one that I want to explain, because it's a little bit peculiar lah. Okay, that way. So what happens? Polestars transferred raw materials at cost of 4 million to South Star. So which means that between Polestar, South Star, they also have transferred raw materials at cost. At cost means what? There is no profit. They bought it for 4 million, Polestar bought it for 4 million, and then they transfer to South Star also at 4 million. But this 4 million, since there is a transfer between the holding and the subsidiary, this will also be treated as part of the intra-company sales and purchases. And of course, the value is 4 million. So over here, since they were sold at cost, So which means that there is no necessity to calculate any profits because profit is kosong ma. Okay, and then what happens? South Star process all of these materials and then they incur additional cost of 1.4 million. Okay, so which means that actually Polestar sold the goods at zero profits to South Star. And then what happens is South Star, they take those inventories that were, the raw materials that were so-called transferred from Polestar and then they process it. Okay, they add another 1.4 million additional direct costs. Okay, so which means the cost to Polestar, to South Star is actually what? The 4 million that was originally transferred by Polestar is 4 million, and then they add on another 1.4 million. Process everything, then they sell back to Polestar. For how much? 9 million. They sold it to Polestar at 9 million. So which means the intra-company sales here again will be 9 million. Agree or not? Because that was the selling price that South Star has sold to Polestar, 9 million. And then what did they tell you? At the end of the year, Polestar still had 1.5 million of these goods still in inventory. There were no other intra-group sales. So, which means what? 4 plus 1.4 is 5.4. So this is total to 5.4. Overall profits for this particular transaction is you compare these two figures. 9 million selling price, 5.4 is the cost. So which means over here, the profit element, if everything has been sold to outsiders, will be 3.6 million. Okay, so this 3.6 million profit is inside the 9 million selling price. So in other words, if you want to so-called do the calculation of the URP that is within the 1.6 million that still has not left the group boundary, we do direct proportion. So which means if the selling price of the goods is 9 million, the profit is 3.6 million. How do we get that? Because the cost, the selling price minus the cost, the profit is 3.6 million. But right now, you have only left behind 1.5 million worth of the goods. So you want to know how much is the profit element inside the 1.5 million worth of closing inventories. So I say if you put it in this particular tabulation, 3.6 divided by 9 times by 1.5, so you're going to get 0.6 million as the profit. And since this particular goods is still in the inventory, this must be your URP. Okay, so this 0.6 million URP, you do the same like in the earlier transactions or adjustments for the URP. So over here, you are going to get what? Your intra-company sales and purchases will be 4 million plus with the 9 million here. So 4 plus 9, this will be your elimination for the for the intra-company sales and purchases. Profit element will be the 0.6 million to be offsetted from the books of the seller. So in this case, the seller will be South Star. Okay, got that? So you see, this is one of the scenario that we hardly see, yeah? Okay, so if this kind of adjustments is being asked, I hope that you know how to do. Okay, then the next one. Polestar has recorded its investment in Southstar at the cost of the immediate cash payment. Other equity investments are carried at fair value through the profit or loss. Okay, so other equity has fallen by 200,000, which means that there will be a loss in equity investment of 200,000. So this particular figure, since it is fair value through the profit or loss, so the 200,000 decline or the loss, you have to reflect it at the profit or loss. And then this one is just like the earlier one on how to calculate to the fair value of the NCI. So how do you calculate? They measure at fair value. Okay, so they tell you Southstar's share price at the date of acquisition will be deemed as the fair value of the non-controlling interest. So you go back to the question. At the date of acquisition of shares in Southstar, the listed market price is $1.20. So, which means you can safely calculate $1.20. How many numbers of shares? 25% times by the 12 million times by the $1.20. That should give you how much is the NCI at fair value. Okay, so you are going to get like 1360. Okay, let me see. If I use 12 million times by $1.20 times by 0.25, so 3.6 million. Okay, and then this last particular note, number 5, tells you that, oh, it could be likely that there is an acquisition during the year. Okay. Okay, so once you have done all these, which means that you can go back and look at the console SOPL, console SOFP. Okay, so this is on Polestar. So you have the consolidated SOPL, and then you are also required to prepare the console SOFP. So there is something that I would like to share with you. I mean, just to highlight to you. Let me go and get the answers over here. Answers. Okay, so you can see the normal ones, not an issue, not an issue. But when you go and calculate the goodwill, can you see the goodwill calculation here? You just check your cost of investment that you have computed earlier, which comprises of cash and the fair value of the contingent consideration. Then you have the NCI measured at fair value. Then you have the net assets. And then you ended up having a negative goodwill. What is a negative goodwill? It is just a bargain purchase. Just have a quick look. Let me just enlarge it. Okay, because I just want to highlight what should be the correct accounting treatment for the bargain purchase. Just have a quick look at this. Okay, so you see over here, you have another approach to calculate what is the net worth, because they started off with the net worth at the end. Then they add back the post-acquisition losses, they make the adjustments for the property. This is also another approach that you can calculate to get how much is the fair value of the net asset at the date of acquisition. So later you have a quick look at this. And then what I want to discuss is with respect to this 3,400 bargain purchase. So usually bargain purchase means what? You buy it real cheap, ma. So if something that is worth 10,000, you probably pay only 7,000 for it. So that means you have a bargain purchase. Okay. So the accounting treatment for bargain purchase is not the same like an impairment, because we know that impairment, that means it's a reduction in the value of the goodwill. So for the impairment, we always say, since the NCI has been measured at fair value, like in this case, all right, if you have any impairment loss, you have to share between the parent and the NCI. But over here, in this case, you don't have to share, all right? So that means some of the people will ask, if impairment loss we share, why is it that now when there is a bargain purchase, do we need to share or not? So the answer here is that when there is a bargain purchase, that means a windfall gain, you do not need to share with the NCI, but you credit it directly to the SOPL. So when you prepare the retained earnings, you can see here, the negative goodwill here, you are going to increase, add on to the GRE figure, this figure. Okay, you got that or not? So when you have a bargain purchase, you just take it to the group retained earnings as a windfall gain. So park it under the column of the holdings. Okay, so you will have this 3,400. And then the other thing is, how are you going to reflect this particular negative goodwill in your console SOPL? So when you prepare your console SOPL, okay, you can see here, administrative expenses. So when you see the administrative expenses, this is like what we have seen in the Pankow and Spear, whereby we actually say whatever figure that you take from the subsidiary, you need to times by 6 out of 12, because in this particular scenario, it was an acquisition during the year. Only when you prepare the console SOPL. You see, when you prepare the console SOFP, you don't have to go and what do you call that? Do any apportionment one. Okay? So over here, subsidiaries figures, when you take to go to the console SOPL, you have to take the time apportionment. Okay? And where did this 4,000 and 9,000 come from? This was from the additional information, the additional information from the question. I think I've closed the file already. Oh, no, it's here. Okay. The 4 million and the 9 million add together, you have to remove 13 million of intra-company sales, 13 million of intra-company purchases. Okay, you got that? So you remove 4, you remove 9. So the cost of sales, you also do the same. Okay, but even though over here the cost of sales, they do a workings, but supposedly not necessary also can. Okay, so what you're going to do is take the holdings figures, subsidiaries figures, make sure that you times by 6 out of 12, then you get to 3,600. Then you have to remove the intra-company purchases. So the intra-company purchases is still the same as when you deduct from the intra-company sales, the 13 million. Then the URP, that we have computed earlier, and then the additional depreciation because of the fair value adjustment that the question requires you to park it under cost of sales. Okay, so you just do campur tolak and then you get to the respective figures. Then you will get to the gross profit, distribution cost, no adjustment really. Administrative expenses, so long that you plug the figure from the subsidiary, you have to times by 6 out of 12. So you will get the figure, and this is the one that the adjustment that you are going to make for the negative goodwill or the bargain purchase in the console SOPL. So this one, what is the explanation? Because the bargain purchase is like a windfall gain. That means you buy something real cheap. So you already indirectly spend less. Okay? But this particular negative goodwill is not something like, it's not like your rental income. Okay, if you have rental income, what you're going to do? You will put it as part of the other income. Why? Because you really receive the money one from the rental, from your tenants. But this particular negative goodwill, you're not going to receive 3,004, but it's just that you know that you paid less to acquire the interest in the subsidiary. So when such is the case, we will treat it like a savings in the expenses. So we will put it as a reduction in the administrative expenses. Reduction. So you see here is a minus, a reduction in the administrative expenses. Okay? So just now we have seen also this one, which is because it was captured at fair value through the profit or loss. So which means any changes in the fair value, you're going to capture it in the profit or loss. So it's a reduction. This particular item, remember there was some fluctuations between the fair value of the contingent consideration at the date of acquisition and the fair value of the contingent consideration at the date of consolidation. So the difference between these two figures is 300. So the contingent consideration has declined. So which means that this is like a windfall gain. So you treat it plus, all right? Then finance cost is just the normal, income tax expense just the normal. The rest of it should be okay. This is the note that I have mentioned. When you have a bargain purchase, the IFRS 3 business combination says negative goodwill should be credited to the acquirer. None of it relates to the NCI. So which means that this is the accounting treatment if you have a bargain purchase. So it is not like if you have a reduction, you share. Then you have a bargain purchase, you also share with the NCI. No. Okay, so which means that if you have an impairment loss and the NCI is measured based on fair value, you are going to share the impairment loss between the holdings and the NCI. However, if you have a bargain purchase, everything accrues to the acquirer. The acquirer, of course, in this case is the holdings. Okay, got that? And then we have this console SOFP. Just have a quick look. Why is it that over here we need to minus the consideration? Okay, so we look at financial asset. Of course, it depends on how the question is being worded. Because they tell you in the SOFP, they didn't show how much is the value or the cost of investment in the subsidiary. They only tell you financial asset, because investment in the sub is also part of the financial asset. So they tell you equity investments, a total of 16 million. So you know that inside this 16 million, suppose you should have a breakdown, which is investment in South Star. Okay, some XX figure. Okay, because over here, when they did all this, they tell you that they have already gotten everything, okay, recorded. So in other words, we must go and remove the investment in South Star from the financial asset that is stated under the column of Polestar. Okay, so if you look at it, that's the reason that you have to remove. Okay, why only remove the cash consideration? Because of the statements as stated in the question. They say what? They made an immediate cash payment of so much. And then they tell you that, this one has not been recorded. Contingent consideration not yet recorded. So which means investment in South Star, they only taken the cash consideration. They haven't recorded the contingent consideration. So if you haven't recorded, of course, you cannot reverse lah. Okay, so you can't eliminate. So the only thing that you can eliminate is with respect to the cash payments. And the cash payments you have computed just now. Cash payments for the consideration is this much. So this is what? 12 million, 75%, $1.50. So this particular portion over here amounted to 13 to 13.5. So this has been recorded. So you need to offset this particular figure. The 1.8 has not been recorded, so there is no necessity for you to offset. Okay? So you have to remove how much? 13.5. Investment in here, 13,500. Okay, 13,500 out of the 16 million here. Okay, so if you look at it, that is how the figures of 13,500 is being eliminated. Okay, and this 200 loss also coincide with this particular what do you call that? The equity. Since 200 is stated here as a loss on the equity, cause the carrying amount of the financial asset will reduce accordingly as well. Okay, so this one no issues. Holdings figures plus with the subsidiaries figures, and remember this is console SOFP. There is no necessity for you to go and pro rata times 6 out of 12 tak ada. Okay, then you remove the URP, so no issues. Then this will be the equity shares, the retained earnings, the NCI. So usually retained earnings, NCI, you need to have the workings. Okay, you need to have the workings. Contingent consideration, 1,500. Okay. Let us have a quick look at the retained earnings. Nothing much already because we have already computed. NCI, also no issues. Okay, this one is another question. Okay, so you think you can work it out again on your own? Can or not? Should be able to lah, You try to work it out again. And then just now, this one okay already. Just now, remember that the Pancras and Sphere, okay? The one on Pancras and Sphere. So the one on Pancras and Sphere, at the end of it, I have this homework that I want you to look at. Okay, so what I would do is I would just crop this one. Crop this question and then put at the meeting chat. Okay, so like I mentioned just now, I would like you to do this particular homework. Complete this homework based on Pancurve and Sphere and submit by what day? 31st plus 31st of August. Okay, that will be an assignment box will be created at MS Teams. So maybe later during the lunch, I will create this particular assignment box. Okay, assignment box will be created at the MS Teams for your submission. Okay, and then later, what I want you to do is just to submit. And then what I will do is I will look at it. You just prepare the explanatory notes. Okay, explanatory notes. The explanatory notes is like the one that I have showed you when we look at Sharp and Nino in the last class. Understand? You try to write some explanatory notes because this will help you when you do the explanation part. Because if you look at the SBR past year questions, you will realize that they no longer ask you to calculate the goodwill. They ask you to explain how goodwill should have been calculated. So which means if the question verb is explain how goodwill should have been calculated, so in other words, they want you to explain why you take this figure, why not the other figure. Okay, and then they also would like you to calculate. But the thing here is that in SBR, when you calculate, they didn't say that you calculate only, but calculation must come together with explanation. So that is why this particular homework is to get you familiarized, to get you a little bit thinking a little bit about how to write the explanatory part. Okay, so when we look at Pancurve and Sphere, there are some of these things that is happening right in the scenario. So when you explain, provide the explanatory notes that time, try to take it from the Pancurve and Sphere's question. So let's say when you talk about share exchange valuation, so you have to mention about, you have to take how many shares that is owned by the, that is acquired by the holdings. The holdings is who? Pancurve in Sphere, and then how many shares for how many shares, and then you have to take the share price of the holding at the date of acquisition. You get what I mean now? This is like explaining the portion on how you do the computation. All right. So same goes with deferred consideration, and then you have to mention about the unwinding. So let's say if you need to apportion, then you also got to explain why an apportionment is required. Okay, and then of course NCI at fair value, which means that you are going to obtain the full goodwill, and should there be any impairment, what you're supposed to do. Okay, so intra-company sales and purchases and the URP. So of course, in the case of Pancurve and Sphere, you only have URP between the parent and the sub. Also, you have between the parent and the associate. So you must explain all as well. Fair value adjustments, you can mention about why they need to be taken into account and should they be attracting any additional depreciation, you also have to provide for them in the post-acquisition period. Land, always remember, you only take the fair value adjustment upwards or downwards. but there is no additional depreciation because land is not depreciated. Okay, then you have investments in the associates. Then you have to mention a little bit about equity accounting, right? Because investments in associates are equity accounted, they are not consolidated. And then give some examples, taking the facts from the Pancurve and sphere. Okay, so this is on Pancurve and sphere. So later I will create the assignment box. You can just put in at the just submit. But when you submit that time, usually the students will be like this. When they submit, of course, you save your file name under whatever file name. But before you write anything, can you just, maybe you want to write Pancurve and sphere. I don't know. Maybe you write Pancurve and sphere. Then I know your file name is named under your name. Okay, but please put your name here. Let's say Ali. Okay, so that because in case I print out, at least I know who I am actually looking at. Okay, you just put your name. Maybe you can write just your name. Of course, this is SBR. So which means that whatever homework, similarly, whatever that I ask you to do, will be for your own good lah. There is no marks attached to the final examination because all will be assessed by ACCA itself. Okay, but all these exercises as well as the quizzes that we have put up basically is for you to get some practice, but more is required on your own to do the past year questions. Because like you see, even though I have the past year questions extracted for you, there is almost like not much of participation. So I don't know whether you are following the classes or not. So maybe because of that, I also don't know how well or how not well you are doing. So maybe you should go and attempt this kind of homework. Okay, so this one, I give you some time to do and then you submit. So then you give me some time to look at it, I review it, then I will return with comments. Okay, so that is how we can communicate lah. But if you don't submit, then there is nothing for me to mark lor. Understand what I mean now? Okay, so maybe we can have an earlier break for lunch today. Right, so now it's about 12. Then we can meet back here at 1 o'clock. Is that okay? So we will break for lunch. Come back at 12. Come back at 12 lah. Come back at 1. Okay, so I see you later. We have one more question to do. I hope that after your lunch, you can contribute and be more participative. And then we are going to continue with another accounting standard, which is on income tax after the lunch. Okay, so you may leave now.